Are you wanting to profit from the stock market but have no idea where to get started? If that's the case, then you came to the right place. This is a stock investment series for beginners where I'm going to show you all the basics that you need to know in order to get started to invest in the stock market with confidence. Let's get started by first understanding what it means to buy a share of stock. When you buy a stock, you're buying an ownership in that business. So in other words, you get to be part owner of a business without actually being or operating the business. Likewise, it's best to treat your stock investment portfolio like a business, where you research into the company thoroughly before you buy, jot down any trades that you make, and invest into education and any tool you need to be successful. Because if you treat investing like a hobby or have a gambling mindset towards it, then your expected returns might be far below your expectations, and it might actually go into the negatives. There's thousands of stocks in the stock market to pick from, but you want to buy and be part owner of the best companies with a competitive advantage because those are the companies that will do well in the long run, and they'll have the ability to buy out their competitors to grow even more. You want to make sure you like what the business stands for, like what they sell, like their business model, because that gives you the conviction to hold on even if you see a 20% drop in the stock price, which, yes, can be very scary if you have no idea why you bought into the stock in the first place. But on the other hand, it's a great buying opportunity if you believe in the business and understand how that stock plays into your stock investment portfolio. Imagine you're about to buy a house to live in. I'm sure you have dedicated a lot of time to doing research and going on house tours before you decided on the dream home. And once you buy that house, you're most likely not going to put the house back onto the market for sale the very next day. Now, the same concept applies for picking and holding stocks for long-term investment. Let's go back to the house as an example and say you found your dream home. So the smart thing to do is you wouldn't buy the house right away if it's way overpriced. Hence, you would go into negotiation with the seller in order to try to get to your desired price. Either negotiation goes well and you get to buy the house at your desired price, or it doesn't go well and you have to find another house to make an offer on, or you can wait until the market condition forces the seller to lower the price in order to get the house sold. Again, the same logic applies when buying a stock. When you find a stock that you want to add into your investment portfolio, wait until it's at a retracement and it's undervalued before buying. So how do you find the right stock and how do you determine a buying point? You need to first understand how the stock price works. So for every buyer, there has to be a seller. It's a 1-to-1 ratio. It takes two to tango. Furthermore, the pricing of a stock is based on supply and demand. So when the stock price moves up, then there's more demand than supply. And in other words, there's more buyers than sellers. Hence, a larger amount of liquidity will be present in that particular stock, which can increase its market cap. And you see that in Apple when it hit its $2 trillion mark. When the stock price falls, then the outcome is the opposite and there's more sellers than buyers. So you can see that no one can predict where the stock price will go in the short term, and no one can predict when the stock market will crash. Because for every buyer who buys thinking that the stock price will go up, there has to be a seller who sells thinking that the stock price will go down. An excellent example is GameStop. You can see here that the stock doesn't move up or down in a straight line and moves in oscillations. These moves are based on the sentiment of the market, which is created through fear and greed. Remember, the stock price doesn't reflect the true worth of the business. The actual worth of the business today is reflected through another calculated price called intrinsic value. No matter how high or how low the stock price is, it will eventually go back to its intrinsic value of the business. Therefore, for long-term investment, you ideally want to wait until the stock price falls below the intrinsic value before buying into the stock. To figure these things out, there's two types of analysis: fundamental analysis and technical analysis. So fundamental analysis calculates the intrinsic value of the business. In other words, what is the business actually worth today based on its reported financial statements, which are all public information. This is where you would analyze the 8K, 10K, 10Q statements for its income, expenses, assets, and liabilities. Technical analysis is used to analyze the movement of the stock price based on the emotion of the market. Now keep in mind, no one can predict if the stock price will move up or down, just like no one can predict when the stock market will crash. Technical analysis just tells you what is more likely to happen to the stock price. However, zero psychic ability is needed to be profitable. It's important to know the difference between investing in the stock market versus trading in the stock market because they come with two very different mindsets. So investing in the stock market, you want to buy a stock of a fundamentally good company and hold on to the stock for years to come. Technical analysis isn't as important in investing, but it gives you an advantage in determining a good buying point. Trading stocks as a business is based on technical analysis. When you trade, have a trading plan of where and when to buy, where to take profit, and where to set stop losses. No matter if you want to invest or trade in the stock market, it's important to treat it as a business and start off small so that you can get used to small losses and small wins and then increase gradually. For example, once you get used to seeing $100 losses and gains, then you can increase your capital and you can get used to seeing $1,000 losses and gains and then increase your capital again and seeing $5,000 losses and gains, for example, and so on and so forth. That's a good way to train your mindset and mental fortitude so you won't freak out when you see big losses and have the guts to forge ahead. Now, if you like this video, check this other one out.